Hey guys, Gwen here with Antero Real Estate. Today we're going to be talking about mortgages. We have our in-house lender, Phil Caulfield, here in the house. And if this is your first time on the channel and you want to know everything about Bay Area real estate, subscribe below, hit the like button so you can learn about the current market in the Bay Area. If you are looking to make a move, give us a call, shoot us a text, or send us an email, and we'd be happy to help you with your move. All right, Phil, you want to introduce yourself?
Sure. My name is Phil Caulfield. I'm a mortgage consultant with Prosperity Home Mortgage. I work here in Burlingame and in San Carlos, but I can help people with loans anywhere in California.
Great, good. So, Phil, I want to go over just a bunch of questions regarding mortgages and finances, and you're the best person to ask. So let's start off here with, what is a pre-approval and what is the process to help educate some of the viewers out there?
A pre-approval is a written loan approval prior to actually getting in contract to buy a home. So basically, it's the exact same process that we do if you're already in contract to buy a home. We get all your income documentation, your asset documentation, a credit report, and we put a package together, we submit it to our underwriter, and then based on all that documentation, we come up with a maximum purchase price and a maximum loan amount so that you can go out and shop with confidence that you'll be able to close escrow once you do get into contract.
Got it. Okay. And roughly, like, how long does that whole process take from, like, say, the first introduction, the first meeting, to all the way up until getting the actual pre-approval?
Yeah, generally it takes about 2 weeks, but a lot of it depends on the client because we give them a list of documents that we need, and the faster they get us their documents, the faster we're able to issue the pre-approval.
Got it. So like the whole document collection process is
correct.
Got it.
Once we have the full package and we submit it to our underwriter, that process right now, it changes, but it's about 2 to 3 days.
Oh, that's fast. Okay, so guys, remember, just stay on top of the document collection. Get it over to Phil when you're doing the pre-approval process, okay? Okay, Phil, next question is, like, how much down payment does the buyer need to actually buy a home here in the Bay Area?
Well, that's a two-part question. Number one, there's lots of different loan programs with different down payment requirements, but since the prices here in the Bay Area are so high, they don't all work. But let's go from one end of the spectrum to the other. If you're a veteran and you have your VA eligibility form, you can actually buy a home with no money down. Then continuing along the spectrum, there are first-time buyer type programs where you can put anywhere from 1% down to 3% down, and those prices, you can do that up to roughly almost $1 million.
Wow. And is that what they call like a FHA loan?
Yeah, FHA is one of those loans that requires 3.5% down, and that's up to $971,000 here in the Bay Area.
Wow, $971,000.
Yes.
Okay.
But there's also other loan programs that are similar to VA that are maybe a little bit harder to qualify for, but they don't have the large mortgage insurance annual premiums and upfront premium that FHA has.
Got it. So what's first of all, what is mortgage insurance, and what's the bare minimum that a buyer needs to put down in order to not require this mortgage insurance?
Mortgage insurance is insurance for the lender against default, and it's usually required when you're making a lower down payment. So if there's less than 20% down, there's the possibility of mortgage insurance. I say possibility because there's ways to avoid it when you're putting less than 20% down. For example, we could do a first mortgage for 80% and a second mortgage for 10%, and that would avoid mortgage insurance by doing two different mortgages.
Got it.
But if you have one loan over 80%, generally speaking, you're going to have to pay for mortgage insurance.
Okay. So 20% is like the threshold.
20% is the threshold where no mortgage insurance is required on any loan programs, as far as I know.
Got it. Okay, nice. So Phil, I understand the 20% is the minimum threshold. Now, is there a benefit for a buyer to put a bigger down payment in the eyes of the lender?
Absolutely. The more you put down as a borrower, the stronger you look to the lender. And you'll also have the benefit of having more flexibility on other parts of your loan file, such as maybe your credit score or the debt to income ratio or the reserves required after closing. Reserves are the amount of money that you have to have sitting in savings or retirement after the loan closes. Most lenders require a certain number of months of the payment in reserves.
Got it. So basically, the bank looks at it as the more money you have, the more lenient they are, so to speak.
Exactly.
Got it. Okay. So Phil, what are the main factors that determine how much a particular borrower can actually borrow from the bank?
Okay. Well, let's start out with the debt to income ratio. The debt to income ratio is the amount of your monthly expenses divided by your gross monthly income. Not your net, your gross. So what the debts are the new housing expense, which is made up of your mortgage payment, your property taxes, your insurance, and any homeowner's dues if you live in an association like a condo or a townhouse.
Got it.
And then added to that are any other debts, such as car payments, credit card payments, or student loans. So what the lender does is they add all those expenses up and divide it by your gross monthly income. And generally speaking, that debt to income ratio shouldn't exceed, depending on the type of loan, 43 to 50% of your gross monthly income.
Got it. Okay.
That's a general rule.
Got it. Okay. Great information. All right. So, Phil, can you explain to the viewers what LTV is and what it stands for, and how does it apply to lending?
Sure. LTV stands for loan to value. So what that is the amount of your loan divided by the value of the property. And generally speaking, the lower the loan to value percentage, the better you look to the lender. For example, if you're buying a home for $1 million and you're only borrowing $100,000, you're looking very strong because you're making a $900,000 down payment. So
got it.
The lower the loan to value, the better you look.
Got it. Okay. So it's like if somebody was to put down 20% down on the purchase price of a home, essentially they're putting an 80% loan to value.
Correct.
Got it. Okay.
Yeah.
Phil, there's different types of banks out there, different types of lenders. So can you just talk a little bit about the different types of mortgage lenders out there?
Sure. There's basically three different types of mortgage lenders you run into. Number one are the banks. You're familiar with all the big banks. Banks have their own loan programs and they fund their loans. The second type is mortgage banks. A mortgage bank is a bank that only lends. They don't have an asset side where you can go and deposit your paycheck or anything like that. A mortgage bank funds the loan and then they sell it off to different investors. They might have a big bank as an investor. They might have a hedge fund that's an investor, or some type of investment company that offers mortgages. So that's the second type. The third type is a mortgage broker. And what a mortgage broker does is they package your loan application, and then they're approved with a bunch of different lenders. And depending on your needs as a borrower, they send it to the lender with the best terms for you.
Got it. Okay.